U.S. corporate bankruptcies just surpassed the total for all of last year. We are in a debt-based system, and the impact of rising interest rates is now starting to be felt in a big way. The increase in the cost of borrowing and the cost of servicing debt for both businesses and individuals is leading to defaults. Corporations and commercial real estate businesses are unable to refinance due to credit tightening, and they're being forced into bankruptcy. This is leading to job losses and decreased consumer spending, which will impact other businesses and trigger a downward spiral of events. This economy is driven by the unusual and unsustainable compounding of debt and derivatives that are now being sold as all the Wall Street products your financial advisor recommends to you. Well, guess what? The Ponzi scheme gets revealed today, coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer, which means you can actually get your gold and silver from us, by the way, if that was your question. But I need to talk to you today about what is unfolding in the markets as you and I are sitting here talking and watching this, because you need to know so that you can get into position to not just weather this storm, but actually benefit from it. Because the markets are schizophrenic. One day they like what's happening, so there's euphoria. Markets are up at all new time highs, high PEs, etc. But then the reality sets in, and then they try and dump, and then they got to keep them supported again. Because what do people do? They open up their 401k statement or their IRA statement, and they go, "Oh, okay, things must be okay as long as the stock market is okay, or as long as the bond market isn't too terribly bad." But look at all of these industries. Oops, let me grab a laser pointer. Look at all of these industries with the most distressed debt. That means they're already having trouble paying their debt. Other, which they're not specific about here, is the largest area. Real estate, telecommunications, retail, software and services, healthcare, and pharma. There is a lot of corporate debt that is in deep, deep doo-doo. At the end of the week, marked by optimism, the Fed would be closer to ending its interest rate hikes. And aren't they coming out and talking about, well, the Fed's at the end of the road, probably at the end of the road. Maybe we'll get one more. Maybe we won't. Maybe it'll be a soft landing. Hey, maybe we'll avoid recession. That is such garbage. Look at this. Don't believe their lies anymore. Because how many times can you be lied to when you do not know the truth? Every single flipping time. The uncertain scale of the lagged effect of prior interest rate hikes means that both recession and a Federal Reserve policy error remain potential risks. Yeah, think? Because I definitely do think that that is what we're seeing. So how do you think if they are going to fight the inflation that they created? Sorry, Randy. Fight the inflation that they created. How are they doing that? By raising the interest rates. I personally think we're going to see a pivot at some point, but I can't tell you when. Is there going to be another rate raise? Well, yeah, they're trying to get back their credibility. Remember when they gave it up a year ago last June? I was amazed that they were so stupid to give it up. But give it up they did. Now they're fighting back for their credibility, and that creates a danger. Because you have all of the kahunas, not just the central bank kahunas, but your business kahunas, Warren Buffett's and Jamie Dimon's and all this, trotting out going, oh, everything is hunky-dory. No recession, blah, blah, blah. But the reality is that banks say conditions for loans to businesses and consumers will keep getting tougher. What does that look like? Well, this is from the Fed, the Federal Reserve Education Department, and this is the net percentage of domestic banks tightening standards for commercial and industrial loans to large and middle market firms. So this is very similar to what's also happening with smaller firms. So here's your businesses, and it's tight. And you can see quite interestingly that when it got tight in the past was with these gray bars, which are official recessions. Now we're up at those levels and no recession. Why? Because of all of anything that they did. All that did is push it off or push the appearance of it off, because not everybody is in the same boat. But it's also for consumers as well. So let's see what that looks like. This is net percentage of domestic banks tightening standards for credit card loans, just as one example. And so you can see that that too is tightening. So you got to ask yourself, is the party over? Right? The game of musical chairs. You know, who's going to be left out? Let's not have it be you. Wall Street new zombies may well be regional banks. Commercial real estate exposure is a growing concern for lenders. But are they the only ones? I don't know. Let's take a look, see what they say. This is the volume of maturing commercial property loans by lender starting in 2023, so this year. And it's from all of the different lenders. Let's just look. This one goes through 2027, so over the next 4.5 years. And it includes CLOs, collateralized loan obligations, which the Bank for International Settlements have talked about. But all of these commercial mortgage-backed securities, investor-driven, private government agency insurance. So these are all the entities that invest in commercial property loans that are maturing, that you buy these products. And they're put in your IRAs, your pensions. It's those institutional investors that invest your money. That's your skin in the game, not theirs. They're just making money from it. And then the last three, International Bank, which is this dark blue, the medium blue is the National Bank, and then the light blue are the regional banks. So I just kind of singled those out because one of the things that I want to point out to you is that while, absolutely 100%, the regional banks are very exposed, and that creates some problems too because they're not lending. It's getting tighter, but it's getting tighter in the entire banking sector. And you can see how much exposure in these are national banks. So these are even your large banks. So when they talk about what happened at SVB or First Republic, right, with the interest rates, right? Interest rates go up, the principal value, the market value of the bonds go down. And they want you to think that it was only in those few banks and this is just kind of unique. It's not. It's throughout the entire banking sector. So what's going to happen if they're not going to roll these loans over? Well, what we are going to see here is that it is getting a lot tighter. This is the net percentage of domestic banks that are tightening standards for commercial real estate loans that are secured by non-farm, non-residential structures. So office buildings, warehouses, etc. And look at how tight that's getting. And all of these loans are coming due. For all of these, including where you might have them, CMBS or CLOs, or simply investor driven, that's CMBS, that's a nice big area. So are you going to be impacted by it? Maybe. And I say that because this maturing debt is not likely to be, most of it is not likely to be rolled over. So that means that you're going to have rising defaults.